Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Dallas, today a new segment.
Listener questions.
Podcast listener questions. So, and it's a welcome back to the podcast booth. So for
this is attempt 3 of our welcome back. We've tried to record this once, got it wrong. Tried to record it again, got it wrong. So we're a bit out of practice.
Dallas, we recorded this podcast yesterday, but we're using new software. For the recording, and Dallas made a monumental mistake and
didn't save it properly.
I haven't saved that properly, so we're re-recording this one today.
If we sound more polished than usual, that's probably why.
And we're actually back in the podcast booth. So in March, of course, we were recording, but we're recording remotely.
By Zoom.
For the obvious reasons, people were working from home. We were working from home at that point in time. And we actually pre-recorded some podcasts as well, because in May and June we have a very busy time with our clients, making sure that they're all taking advantage of tax deductions for the year as we approach the financial year. So it's mid-July, and we've
got some more time to get back
just back in podcasting mode. So we'll be certainly recording quite a lot and releasing 2 per week. And
that's what we wanted to ask the audience. So we've got as you said, a new segment for listener questions, which was something that we stumbled on because a couple of different people have emailed us and asked us questions that they want us to answer. So we sort of formalised that a bit. We've now got an email address that you can email directly with questions for the podcast, and that's podcast@mo50.com.au. So if you have any questions or have anything that you'd like us to discuss, feel free to send that through.
Yeah, and that can be a question or a series of questions, or even just a topic. It might just be a topic. Can you guys elaborate on this?
We are pretty good at just taking a minute topic and debating it back and forth for an hour. So no topic too small. We're happy to go through anything. So. Today's question was from Ange. So thanks, Ange, for sending that through. So Ange wanted to know about basically retirement planning for low-income earners, and specifically around super contributions and whether that should still be their main focus for people who are on a lower income. So thanks for sending that through, Ange. So the first point that I just want to make before we get into the hows of how to best get set up for retirement if you're on a low income. I just wanted we touch on the fact that I think for a lot of people, if you're on a lower income, it can seem very hard to get set up for retirement. But the reality is that, as we sort of talked about, your ratio of how much you spend versus save is really the most important thing that affects how quickly you're building up savings. And then the amount of income that you need to spend each year when you're in retirement is one of the biggest things that affects how much you actually need in retirement savings. So if you are on a lower income, it can seem harder to build up your super balance and to build up your retirement savings. However, the flip side of that is you probably just need less money in retirement savings as well. So the target that you're shooting towards is obviously going to be a lot less.
Yeah, certainly. And also, it's a good point. Also, sometimes people get a little bit worried about retiring with a certain amount and a figure. I mean, much of the stuff that we'll talk about today is along the vein of you can only do what you can do. So if you are on a low income, what we encourage people to do is just to take the low-hanging fruit and to do realistically all that they can afford to do to improve their situation. And any improvement is an improvement. And sometimes it's a little bit redundant to be thinking too much about a specific retirement dollar figure or anything, as long as you're doing all you can do and picking up the low-hanging fruit.
And that's a good point for everyone, I think, of all income levels, is that you really, it's a bit like anything. There's no point comparing yourself to other people or where you feel like you should be. It's really just about going, am I doing everything I can to put myself in the best position that I can and that I'm able to? And if you are, then there's no point beating yourself up over whether I should be doing more or doing less or anything like that. It's really just about working out a plan that you can stick to and that you are going to stick to, and that's going to put you in the best possible position. So I guess the main things that, I guess, to cover off on that we would say that stay the same if you're on a lower income compared to being on a higher income, what are the things that are the same for everyone of all different income levels? The big thing there for me is the investment strategy. So regardless of your income, of your earned income from work, you want to make sure that whatever you've got in super or whatever you've got in terms of your retirement savings, you want to make sure that you're working that as hard as possible. So whether you're on a high income or low income, that to me stays the same. And we've talked about that at great length on the podcast about looking at the investment strategy of your super fund and that sort of thing, and making sure that you are squeezing every extra dollar of return that you can out of that. So I think to me that's the first thing, is that as we usually do, answer the question with not the answer to the question, but things that are the same to me are making sure that you're doing that.
Yeah, what Alice is referring to there is my comment before is that when you retire, or even before you retire, your money goes to work for you.
Yeah.
And once you've retired, you stop getting dressed and going to work.
Yeah.
As we've also commented, hopefully you're still getting dressed at some stage during the day and not just lying
or
there.
Not, whatever you want to do. It's your retirement.
But your money now gets dressed and go to work. So you're talking about the difference between a 1% average rate of return per year and an 8% average rate of return.
That's exactly right.
And how hard you work your money. And how much lazy money that you have there. So that stays the same no matter how much that you have.
Yes. Yeah.
And look, that's a challenge for people, whether they have $1.6 million to retire with or $200,000.
Yes,
so
that's exactly
they
right.
have the same challenge.
Yeah.
It's about actually working your money hard enough so it earns enough of a rate of return to generate your income needs.
Yep. And just on that, I guess one that I think it's probably another podcast of its own, but what I find a lot is that people who have a lower amount of retirement savings leading into retirement, so they sometimes want to be invested more conservatively because they kind of go, okay, I've only got 400,000, I've got 500,000, or I've got 800,000, whatever the figure is relative to the income they need. As you just said, those ratios are still all the same. You still need to take an income. You still need that money to be going to work for you. If anything, you can potentially afford to have your balance be more volatile, given that Centrelink is likely to kick in much sooner for you if you've got less in retirement savings. So I'll park that off to one side because that's probably a topic of its own as to how to invest your money in retirement if you are relying on Centrelink as well. But I guess the thing I'd say is it's not something where you go, I've only got a small amount of retirement savings, so I can just leave it in a term deposit or in cash or that sort of thing, and just spend down off that. You still need to be working that money hard.
Yep.
So to now finally, after 10 minutes, actually start answering the question of what things are different for lower income earners. So tax planning is probably the big one that changes a bit. And what I mean by that is there's two types of tax planning. So there's your income tax, so the tax that is withheld or that you pay every year on your earned income, and that tends to be a much bigger issue for people who are on higher income. So if you're earning $100,000 a year in gross income from wages, you're going to pay somewhere around $26,000, $27,000 in income tax. Whereas if you're earning substantially less than that figure as a line item of your budget, your income tax is far less. So it's not as important to try and minimise that. I mean, you always want to minimise it, but there's probably just less scope to do that. And so that's one type which we'll talk briefly about is how to minimise the tax on a lower income, on your earned income. The second type of tax that everyone is paying right now and most people are not aware of is the tax on the earnings of your retirement savings. And so that's around, if, like we said, if you've got $400,000 in your superannuation fund or invested in your own name or however you've got that, the earnings that you get on that every year, there is some tax paid on that. So that's one that happens behind the scenes. So we'll talk about that separately, but I think if we go back to the earned income first, because that's what people tend to think of really when we're looking at tax planning. So the first thing that that I'd explain a bit briefly about there is obviously we have a progressive tax system in Australia whereby, and these are all sort of rules of thumb, and there's different tax offsets.
Progressive makes it sound like it keeps getting better. So it's,
that's true.
You're talking about progressing through the income tax brackets.
That's true. Actually, when I say progressive, I don't mean it's really forward thinking and there's none of that. Basically, on around the first $20,000 that you earn, you pay no tax, and then from $20,000 up to about $37,000, you pay about 19 cents in the dollar on that income, and then from $37,000 onwards, you're paying 34.5 cents in the dollar, and then 90,000 it goes up, and then 180,000 it goes up. So this is sort of what we're talking about, where if you're earning $100,000 a year, every dollar of tax deductions you get actually saves you 39 cents in that. Whereas if you're earning $30,000 a year, even if you can reduce your taxable income slightly, you're only picking up a 19% saving on that. And those numbers are sort of important because one of the easy bang for your buck ways to save tax is to make before tax or salary sacrifice contributions into super. So that's kind of one of the first levers that we tend to pull for people on a higher income. Yeah,
so someone smack bang in the 34.5% tax bracket, so they put in $10,000 to superannuation, either by salary sacrifice or claiming it as a tax deduction at the end of the year. What you're referring to there is that they effectively save 34.5% tax. They pay 34.5% tax on that income. So if I'm on a 34.5% tax rate, which would mean that I earn between $37,000 and $87,000 of taxable income. Basically, if I put $10,000 into superannuation and want to claim that as a tax deduction, now think salary sacrifice as your most common type of way to do that, but there are other ways to do that. What happens is that I effectively save 34.5% tax on that $10,000
in your income tax on that.
On my income tax, so I get back an extra $3,450 in tax return. What happens though is that I pay 15% tax, which is called super contributions tax. So just think if you're claiming the contribution as a tax deduction, then you pay 15% tax on the way in. If you're not claiming it as a tax deduction, you pay 0% tax.
So and that's one that most people don't know about because, again, that's levied by the super fund. It happens behind the scenes. It's something that we don't tend to see. So that includes your employer contributions as well as your contributions that you're claiming a tax deduction for. They get taxed at 15% on the way in.
That's right. Now, at that tax rate, it makes complete sense for me to do that because I arbitrage it. I know that I'm going to get back 34.5% tax on that contribution. I know that I'm going to pay 15% tax. If we subtract them, it's really a free money percentage of 19.5%, or it's an overnight return of 19.5%. Look, if I could borrow and put in $10 million, I would put this on like Brill cream as a
like Brill cream. Is anyone still putting Brill cream on?
But of course there's a limit. There's the limit of $25,000 per year,
and obviously there's also a limit of of how much income you have at that marginal bracket. And this is sort of the point that you're making is it really makes sense to do that until the point that your taxable income gets to $37,000.
That's right. So if we pop down one tax bracket, I earn between $20,000 and $37,000. I'm on a 19% marginal rate of tax. Now, I do the same thing. I put $10,000 in. I claim that as a 19% tax deduction, but I'm levied tax of 15%, super contributions tax on the way in. So it's still a 4% rate of return. However, if my income is under $37,000, the spouse contribution and also the government co-contribution,
so
that will actually yield me a better return. So there's really a pecking order here, isn't there?
There is. And that's I guess the other point is, as we talk about this, it may not necessarily be only one or the other. It's normally a combination of each of these things. But to explain what you're talking about there is that if instead of making before tax contributions, I choose to, and my income is below $37,000, or it's below, I think it's actually $39,800, I can put $1,000 of after-tax income into superannuation. So instead of salary sacrificing it in, and basically I pay my 19% income tax on that, it hits my bank account, I pay that money, $1,000 into my super fund. What happens there at the end of the year is the government will look at that and see that my income is below the threshold of $39,800. They'll actually give me a co-contribution of $500 as an extra top-up to my balance.
Yeah, so think of that as an overnight return of 50%.
Yeah.
It's free money of $500. $1,000 goes in.
Yeah.
You get $500 from the government. Again, if you could borrow $1 million and they allowed, they paid you $500,000.
Yeah.
You would put that on like Brill cream.
Yeah. And that's like you say, there's a pecking order there where if you're earning $35,000, for example, the first thing you do is $1,000.
Yep.
Because there's a 50% overnight return. It sounds like a spiel that like someone who buys or sells gold would have on TV at 2:00 in the morning of a 50% overnight return. But it actually is, it is that good up to that $1,000 mark that you can put in. So that's, like you say, in terms of pecking order, that's the first thing you do. Put that $1,000 in, get the $500 top up. So as you said, that would be a far better way to do it compared to making before tax contributions, because your real saving there is only 4%. So you're only getting a 4% sort of overnight return. So the other type of contribution that is, if we move next down the pecking order, the government co-contribution is the best one for that $1,000, get the $500. Probably the next best one, if it's relevant, and this is a bit harder to work out because you need to also work out your spouse's taxable income. There's another type of contribution called a spouse contribution, where you can put up to $3,000, and it's basically seen as your spouse putting $3,000 into your account, even though it doesn't have to be from your spouse. It can be from a joint bank account or whatever.
Yep.
They put $3,000 into your super fund as a spouse contribution. They actually get to claim an 18% tax offset on that contribution. So on $3,000, that'd be $540. So as we just said there in the pecking order, that's also a pretty good one, because you're picking up an 18% overnight return there. When they go and do their tax return, they will get an offset for that $540. So those are probably the two main ones for people earning below $37,000, and they're not huge dollar amounts. But as we talked about earlier, when your retirement savings target is lower, a combination of these two can do a lot of the work for you. So if you've got a couple both earning $30,000 and they've got a spare $8,000 in net income throughout the year, potentially they could make $1,000 each into super as an after-tax contribution to get their $500 co-contribution, and then they could also make a $3,000 spouse contribution into each other's account to pick up that $540 tax offset. So by making that $8,000 in total contributions, they've picked up over $2,000 worth of extra benefits. So again, it's kind of one of those things where if you do that every year over the last 10 or 15 years, it can make a huge difference. You're effectively getting a $10,000 benefit for the cost of $8,000 every year. So it's a really handy one for people that are both, particularly where the couples are both earning under that $37,000 mark. Yeah. the other thing to take into account is that, as you said, there may well be a situation where you could potentially make before tax contributions as well, and depending on your situation, it might make sense. But those are going to be the best bang for your buck, which is what we're all about, is trying to squeeze the easy money, that easy return out in terms of tax savings that we possibly can. So that's the main ones. Now, I just made a note here as well, is that if you're looking at making contributions to super and you're not sure what your taxable income is going to be for the year, and I've got a couple of clients in this boat, what we actually do is, rather than salary sacrifice that money in via your payroll, so rather than make a before tax contribution direct from your payroll and have that taxed at 15% on the way in, what you can actually do is make that as a personal contribution. And we've spoken about this on other podcasts, where you can actually put that money in directly from your bank account, and then at the end of the year you can make a decision as to whether you want to claim a deduction for that or not.
Yeah, so this is this would be very confusing for the listener. So we'll just use a simple example here.
Yeah.
You're not sure what your taxable income is going to be. You say, okay, I'm gonna contribute $10,000, for example, from my bank account into superannuation. That money's not taxed at all. So they assume that it's gone in as and you won't be claiming a tax deduction for that.
Yep.
You get to the end of the financial year, and one of the really handy things now as well, you can do this after the financial year is closed off. You don't actually have to make a nomination during that financial year. So you get to that situation and you work out, okay, what's happened here is that it makes sense for me now to claim $5,000 of that, $10,000 that went in as a tax deduction, and leave the other $5,000 to go in as a personal contribution or after-tax contribution. So what essentially happens, you can lodge a form with your super fund called a notice of intent to claim a tax deduction form. You can single out a portion of that $10,000. In this example, we say, okay, we're going to claim $5,000. The super fund will then tax that $5,000 of the 10 at 15% contributions tax, but you'll take that receipt to your accountant and you'll claim that $5,000 as a personal tax deduction. So it's a really handy way to do that.
I've actually got a real life case study of this one where, and I didn't explain when we were talking about the government co-contributions, but another thing to bear in mind is that ratio of 50 cents for every dollar you put in up to that $1,000, that isn't a cut off at 39,800. If your income's slightly higher than that, you'll still get some government co-contribution, but it might be, instead of getting $500, you'll get $400 and then $300 and then $200, depending on what your income is. So I've actually got a client who the taxable income, they were on track for around $40,000 for the year. So what we actually did was we made a $4,000 contribution into super, and then we lodged a notice of intent to claim form. So we claimed a tax deduction for $3,000 out of that $4,000. So the theory there being that top $3,000 of their taxable income, they're paying 34.5% on. So we've picked up the 19.5% tax saving on that. However, $1,000 out of that $4,000 we actually left as an after-tax contribution, so that they would then pick up, and depending on what their adjusted tax, it might be $500 or it might be $400, depending on which category they fall into there. But that's kind of, as you're saying, there's a pecking order there where in some situations you might actually make those contributions throughout the year and then decide after the fact, do I want to try for the government co-contribution or do I want to claim the actual tax deduction on that amount?
Yeah, it's a really handy way to do that now, and previously, because it's relatively new legislation now. Previously, you had to decide early in the financial year which type the contribution was going to be if you were making it if you were spreading it out over that financial year, and you could get to the situation where by the end of the financial year things didn't pan out the way you thought they would from an income point of view, and you may have actually been taxed detrimentally.
Yeah. So that's as you say, it's pretty confusing, really, isn't it? Like,
look, it's great for us because it is so confusing, and I mean we live and breathe it every single day, so we can work out exactly the way to pull the trigger at the most.
I was just thinking, even the language used where you go, now, depending on your taxable income and your adjusted taxable income, we'll determine whether you should make a concessional or a non-concessional contribution, and then if you should do that, then you need to lodge a notice of intent to claim a tax deduction form with your superannuation. I'm going, what a nightmare.
Yeah, so for our clients, we tell them what to do. Yeah. We actually give them the BPay and biller code and say, pay $3,000 in via this BPay code. Yeah. Pay $1,000 in via this BPay code. Basically we're going to now give you the pre-filled form, notice of intent to claim a tax deduction. All you need to do is sign that. We lodge that with your super fund. Yeah. We package that all together for our clients in a summary to their accountant, so their accountant actually doesn't miss anything. Hey, this is what we've done. We've done this, and this. Here's the tax deductions that they have. So, I guess that's the second part of really what we do there is actually doing it. We talk about financial doing, and Kylie Hatfield, our director of financial doing, does. We say we do that, but it's actually Kylie, our extremely efficient director of financial doing that does all of that.
Yeah, that's right. And that's I guess the other part of it with this, I'd say, is we're talking about make contributions on a regular basis, and then at the end of the financial year, you can worry a bit about how to claim that and whether to claim it, all the rest of it. A big thing with this is, to me, doing something, it's easy to get caught up in what's the optimal strategy. Yeah. The reality is, if you put money into your super fund on a regular basis, whether it's before tax, after tax, however you skin that cat, you're going to be in a better position if you don't do that. So, even though this is confusing, I would say that the most important thing to do there is to go, well, you still need to take action. So there's no point sort of throwing your hands up and going, well, it's confusing and it's complicated. It is. I completely empathise. There's no need for our retirement savings system to be this hard, but that's the reality. All we've got is to do what we can and work within that system, and I think that's where making those regular contributions is the key, because if you wait until the end of the financial year and say, well, I can put $5,000 into super and claim a deduction for it, for a lot of people, it's just not going to happen.
That's a really good point, because you don't get paid once a year. Yeah. You get paid weekly or you get paid fortnightly. Yep. So it's important to split up those contributions into bite-sized chunks as you get paid. Yeah. And I've even had so many comments where people have actually said to me, hey, I'm not too sure if we can afford this fortnightly contribution. I said, well, that's really easy. Let's stress test it. Yeah. Let's start it. Yeah. And you're not locked into it. No. So you can make it this fortnight, you can make it the next fortnight. We might have to adjust that a little bit if there's expenses that come up.
That's right.
But, even if you're making 2 out of every 4 fortnights contribution, it's better than now, which is 0. Yeah. You know what I mean? So.
Yeah, exactly. No, that's right, and that's I think, and it sort of ties into the next point that we're going to talk about is the tax on the earnings on that money. So whether you should be putting that money, someone said to me, should I be putting money into super, or should I be setting up an investment in my own name? The answer is yes, you should do that. One of those two. So
this is I know what you're going to say here. It's a good one to go through, but it's just such a 1%er. A 1%er, yeah.
So this is referring to so as you're saving that money, you have the choice of either contributing into your super via those different types of contributions we've just talked about, or just investing that money in your own name. So just setting up an investment in your personal name and joint names. So the difference there is when we're talking about the difference, it's on the tax rate on the earnings. So in the same way that superannuation has a contributions tax rate of 15%, any earnings on that money is also taxed at 15%.
Yep, and by earnings you mean the rate of return.
Rate of return, effectively, Yep, exactly right. So again, that's a really handy one for people on higher incomes, because if your marginal tax rate's 34.5%, as your retirement savings builds up and there's a higher and higher amount in terms of return every year, if that's getting added to your taxable income, that is chewing into that return, because you have to pay extra tax on that. So, whereas if that's inside superannuation, the maximum rate you'll ever pay is 15%. However, as we said there, if your taxable income is below $20,000, you may be in a situation where you're actually better off investing that in your own name and paying a 0% tax rate on that rather than the 15% tax within superannuation.
So I have an example there, and really, out of all my clients, I can only think of one that this is affected. So I have a husband and wife, and the wife is working but earning under $20,000 a year, like a very limited income. The husband's earning a bigger income. Now they actually had some fairly healthy savings, and what we had come up with is they were either going to put those savings into superannuation and invest it through their super fund, or they were going to invest it in their own name or names. What we worked out is that we were better off starting an investment in the wife's name because her marginal rate of tax is 0%. So we're talking about $100,000 here. So if we'd put that into super fund, either her super fund, let's use as the example, the return on that money, or the earnings, or the rate of return. So just call it $10,000 in a year. She would lose 15% tax on that, which would be $1,500.
Versus being in her name.
Her name.
No tax to pay.
There was no tax to pay on that money. So there's a $1,500 tax saving.
But there's actually more than that, wasn't it?
Well, I don't want to really confuse the issue, but I will. Let's go. So there's a thing called a franking credit. So basically, the companies that she owns, the Australian companies that she owns from that money that she's invested. And by the way, that money's grown higher now. Those Australian companies pay tax at 30% on the dollar in their profits. As an Australian resident for tax purposes, you get a credit for that tax that's being paid. So basically for her, because her marginal rate of tax is 0%, she's paid 30% tax at the company level, the companies that she owns.
She gets a refund.
So she gets a refund of that, which is about $4,000 or $5,000 a year.
I think we did do a podcast about franking credits, and
we did. There is a podcast called Franking Credits. Not just a great race also. So essentially what's happened here is that she gets a tax return of $4,000 or $5,000 a year from those excess franking credits. Now, we put $1,000 back in to her super fund. She gets the government co-contribution of $500. We also put $3,000 in as a spouse contribution. Her husband, who's on a 39% marginal rate of tax, gets a $540 tax offset there. And in addition to that, he's also salary sacrificing about $15,000 a year. So the one family is actually taking advantage of these things. Each of these.
So the before tax contributions, so salary sacrifice contributions,
Yep.
The government co-contribution, the spouse contribution, and the tax offset with that, and also the earnings tax and getting that
the earnings tax and the franking
credit refund.
Yeah. So. Now, just to be clear, your super fund, if she's invested that $100,000 into the super fund, while she'd be paying tax of 15% on the return, she would still get the same franking credit of $4,000 or $5,000 tax rebate in there. It's just that there'd be an extra $1,500.
It's very humble of you, Matt, to say that. It's not all the $5,000. It's not all money.
No. But that's right. But interestingly enough, in their case, they wouldn't actually have the ability to put the spouse contribution in and the $1,000 for the government co-contribution if we'd already put that money into superannuation. They just wouldn't have the cash flow to do that.
The other trade-off with a lot of this, and like I say, where you go, if sometimes with people putting money into super, it's the same trade-off that applies whether it's before tax contributions or after tax or whatever, is that there's also an issue of being able to access that money. So sometimes it can be trickier for people to say, I'm just going to put every spare dollar I've got into super if they are, just turned 50 and they've got 10 years to go until they can access that money. So
look, it's a double-edged sword, that one. because I find from a mental point of view,
it's great,
or a psychological point of view, you put money into superannuation, you've just written that money off.
Yeah.
And you've written it off for your retirement. I mean, I don't mean you've written it off.
No,
I mean, you've forgotten about it. Whereas every dollar you put into an investment that you can access, people find a way to access it.
There's a separation, I think, of like the future version of yourself and the present version. So if you put money into super, it's very clearly for your future retired self. Because you don't have the choice of, should I use that money to go for a holiday now, or should I use it to go for a holiday in 10 years' time?
Yeah.
It's taken out of your hands. It has to be for 10 years' time.
Yeah.
Whereas, as you said, even as you're building up an investment, it's pretty hard to watch that building up and not go, oh, well, maybe I should just take a rake of it off the top.
Well, I actually had to come up with a rule years ago for my clients, and I basically said, treat every dollar that you put into an investment as gone for the next 10 years.
Yeah.
I don't care if you need to dial down how much you need to put in there. So if you're putting in $1,000 a fortnight, that only goes one way. Now, if you have to stop for 10 fortnights and save that $1,000 or spend that $1,000 or do whatever you want with that, that's fine. But every $1,000 that you put into that investment, or every $500 you put in that investment, treat it as if it's gone. Because people were actually, what they were doing is putting too much in there, and then they were pulling money back out as a bank account, like it was a bank account. And actually just treading water for a lot of the time.
And you're right, and that's where superannuation is a great system for this. When we're looking at retirement savings, and that's probably a good point, is even if you're 50 now and it actually makes you be makes you really think about what can I afford to do every fortnight, every week, and not touch for 10 years, because there isn't the same incentive to go, well, I think I can afford this much each fortnight, but then I will, if I need to, I can get at that.
Yeah, that's right.
It's gone for good. So, well, I think that little case study is probably a good place to sort of wrap up there. As we said, so new segment with the listener questions. If anyone has anything else that they'd like us to discuss, any other questions, feel free to email us at podcast@mo50.com.au.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.